Hi guys, Josh here. I hope you're all well. Let's just check that we're going live just to make sure I'm not talking to myself because I have a habit of doing that sometimes. Okay, cool. Looks like we're live, so let's jump straight into it. For today's live at 5 on Friday. Who's watching? Please do say hi so I know that I'm not talking to myself. What are you guys up to this weekend? Any exciting plans? Drop them in the comments. Let me know and let's discuss. But today we're going to be talking about what you need to know when refinancing your properties. So we're going to come at this from two angles. Those people that own their properties in their own name, and again for those that own them through a limited company, because the treatment is slightly different depending on what happens with the cash from the refinance proceeds. Hi Daniel. Perfect. So let's just let a couple people join on now. Just before we start kicking it off and really going through the content. How's everybody's day been? Let me know. Andrew, hi. Perfect. If you're watching, please do say hi. It kind of makes it a bit more personal rather than I feel like I'm just talking to myself, staring at a camera. But yeah, we've got quite a few people on now, so let's kick things off. So when you refinance a property that you own through your own name, what happens from a tax perspective? Well, you'll be pleased to know that when you refinance a property you own through your own name, for instance, when it's increased in value, you're doing the BRR strategy, and you've had that uplift in value and you're looking to pull some money out, the good news is that that's actually tax-free. So as long as you refinance in your own name, your property has gone up in value. It was worth 100, it's now worth 200. The extra debt that you take on isn't actually a sale for tax purposes. So what this means is that there's no tax to pay. Usually you pay capital gains tax. That's when you come to sell the property. However, when you refinance, it's not a disposal for capital gains tax purposes. It is simply a accumulation of further debt. However, there is one thing to watch out for, which is the finance costs. So if you reinvest these additional funds that you've brought out of the property, the equity you've released, if you put that into further properties, and that will still form part of your finance costs. However, with Section 24, the benefit of these does only really impact. So if you're a higher rate taxpayer, essentially, then you're obviously impacted by Section 24. But most importantly, so if you refinance a property and you bring the money out of your property business, so you pull 50k out, you go on a worldwide cruise, something along those lines, something extravagant, you buy a new car. The important thing here to recognise is that this is no longer a qualifying finance costs, which means even when it comes to calculating your tax credit, you will not be eligible for that basic rate tax deduction on the extra debt. So that's enough about the individual name side of things. We'll also run through now the limited company treatment. So as a limited company, if you purchase a property for £100,000, it's now worth 200. You refinance, put a good chunk of cash out. You might pull £50,000 out. The company receives this completely tax-free because, again, for tax purposes, there's got to be a disposal for there to be tax due on this. No disposal, no tax. This is simply just borrowing more money. The fact that it's secured on one of your properties is irrelevant. It's the same as you going to TSB, Santander, someone getting a business overdraft, some other type of long-term secured finance. That's what matters for this purpose. So the property's been refinanced. The company's got these funds tax-free. Because it's just further debt, there's no disposal. Now, it depends what the company does with these funds as to the tax issue. So a lot of people kind of fail to appreciate that your limited company is actually separate from you, both legally, financially, and more importantly, from a tax perspective. So what you have to remember is that you just can't pull this money out of the company tax-free. If you've got a director's loan account, there's a chance that you're about to pull it out up to the balance on your loan account. However, if you've not got dividends if you've not got sufficient retained profits, you probably won't be able to take a dividend. And remember that the revaluation of investment property usually doesn't allow you to actually take a dividend because there's not a materialised gain in the company accounts. So you could pay a salary, however, often that is taxed quite heavily and more aggressively than dividends or indeed repaying a director's loan account. So usually, if you've just refinanced a property, you probably can't actually bring the money out yourself, but you can reinvest it into other properties without any tax on that. So this is a fantastic way just to snowball your cash pile, keep purchasing more and more properties. You'll pay tax on the rental income, yeah, absolutely. But on the refinance, bringing the equity out of the property, there's no tax to pay on that. There's no disposal. So that's kind of my piece on that. That's what I wanted to say, because we get asked this question a lot. Is, oh yeah, I'm refinancing my property. What are the tax implications? I've spoken to my mortgage broker and all that kind of rubbish. Well, I've settled it. So no disposal. There's no tax to pay. Equity release, refinance it. And there's no tax issues around that. So that's all for today, guys. It's Friday. I'm going to head home. Everyone have a great weekend. I look forward to seeing you on Monday for Mondays live at 5. It's every day now during the week. So make sure you tune in. And cheers for watching, guys. Have a great weekend.